Hi, I'm Finucane, Chief Investment Officer at Oxbow Advisors. Here's how we're seeing things after a choppy trading market in November. During the first 3 weeks of November, major stock indices fell in value by 5 to 7% as investors became concerned that the Federal Reserve would not cut rates in December. But multiple members of the Fed board spoke publicly in the back half of the month, signaling another 25 basis point cut is coming. Stocks have returned to near all-time high levels since then. We used the pullback to add to a few of our favorite positions in the long-term growth stock strategy, like Franco-Nevada and Booking Holdings. But the correction did not go deep enough to make us want to significantly increase our stock allocation. We think equity investors are also more bullish because it looks like we know who the next Fed chairman will be. After a long period when it was uncertain who would take over for Chairman Powell next spring, it now looks like Kevin Hassett is the clear frontrunner for the position. Hassett is expected to cut the Fed funds rate further than other candidates would have. We do not agree with that approach when the annual inflation rate is still at 2.5% to 3%, but we must play the market as it is. Now that we expect a deeper cut to the 3-month yield, we have moved more of our 3 to 6 month Treasury holdings out to positions in the 2-year Treasury. We want to lock in that 3.5% annual yield. The expected increase in monetary stimulus gives us more conviction to hold our precious metals positions and add to our other commodity positions too. While share prices continue to make new highs, the free cash flow growth of the largest companies has slowed. The gap between price and free cash flow looks like what we experienced in 2000 and 2021. Like those prior cases, we expect today's situation to play out similarly, where investing in an index with a 3% trailing free cash flow yield leads to disappointing multi-year returns going forward. We target around a 5% free cash flow yield in our long-term growth stock strategy, which we believe better protects us on the downside if a bear market occurs. We mentioned earlier in the year that the big tech companies investing in AI were about to start issuing debt to fund that build-out. It's really ramping up now. The 5 largest players in this market have increased their bond issuance in 2025 by almost 5 times compared to last year. We think investors are becoming more wary of this level of CapEx spending and the financing required to fund it. Since September, Oracle's share price is down 38%, Meta is down 14%, and Microsoft and Amazon are about flat. Next, we want to remind everyone that these 15-plus year bull markets in stocks do not last forever. A good chart from GavCal Research illustrates this. From 1968 to 1982, adjusted for inflation, the S&P 500 declined in value by more than 60%. This is not a one-time occurrence. From 1929 to 1938, adjusted for inflation, the S&P 500 fell in value by 67%. And again, from March 2000 to March 2009, the market's real value declined by more than 60%. The past 17 years have been amazing for stock investors, but now we would rather have a balanced portfolio that includes shorter-term treasuries, precious metals, and other commodity exposure, so our downside is much lower than for a pure equity investor. We are hearing again that investing in energy stocks is a waste of time and they won't go anywhere. We disagree. After a stellar 2-year run into the summer of 2022, the energy sector has only delivered about a 4% annual return over the past 3.5 years. Market participants are pricing oil into the future at $60 per barrel for the next decade. From this perspective, it looks like there is no upside available. What you don't see is for decades, the forward contracts have often expected the current price to stay the same for years ahead, whether it was $20 a barrel in 2002 or $100 a barrel in 2012. In reality, the oil price moves a lot more than a model would suggest. We think the next significant oil price swing is higher rather than lower because the demand for oil is still intact. The world has numerous uses for oil, and most critically, it's the increased demand from emerging economies that is projected to drive overall oil demand growth for the next 25 years. Given the increased capital discipline by oil producers, we do not expect supply to outpace demand. We are keeping our exposure to oil and natural gas and even adding to it when we find a new opportunity, such as National Energy Services Reunited. We hope that gives you a sense of what we're seeing in the markets today. If you have any questions or would like to learn more about Oxbow, please contact us. We like to provide the content we think is most valuable for studying the financial markets today. If you'd like to learn more, please subscribe to our Oxbow Advisors YouTube channel.